okay? You get paid, well, you don't get paid, because when you're gone, then somebody else gets paid, but when you die, that beneficiary gets paid. So really what we call life insurance, I guess you're insuring your life, but then when you die, that's when it pays off, so I call it death insurance. Well, the IUL, the Indexed Universal Life, has a lot more flexibility, and in this little drawing over here, we can see that the IUL can help you with all of these financial challenges with one product. So let's go a little bit further with this. It first of all is, and I'm going to just call it an IUL. I'm not going to say the whole thing, Indexed Universal Life, okay? You all got that? It's an IUL. That'll save me a little bit. It's kind of a tongue twister. But permanent insurance means that what? It remains in effect for a lifetime. Now there is a caveat on that, right? What is a lifetime? Is it 50 years? Is it 70 years? Well, this is 121 years. On your 121st birthday, the coverage is gone. So for those of you planning to live to be at least 121, you have to keep that in mind. For the rest of us, it's a non-factor, right? Most of us realize we're probably not going to live that long. But it is there. In other words, it is permanent. It's there for a lifetime. It's flexible, which means the face amount and premiums can be adjusted if necessary. When would it be necessary to adjust the face amount? Well, what I call it is when life happens. Okay, some change in your life, and the first thing we think of, maybe you get married. Okay, now it's not just you have to consider. You've got a spouse to consider. Then you have children. Now you've got to take care of them and make sure they're covered. And then other things happen. Maybe you get a promotion. You're making more money, and you want to do other things. You go out and you buy that big house. Now you've got a big liability that you have to worry about. So there are lots of things that come along that can change what your perspective is, and you have to be able to be flexible. Also, this is just the thing that blew my mind about this IUL, is it has these things called living benefits. And basically that means these are benefits that you can use from your life insurance or death insurance policy while you're still living. Now that still just blows my mind when I think about it, because I grew up in a time when there wasn't anything like that. You just had whole life insurance and you built up a little bit of cash value, nothing compared to what you put into it, and then you had a death benefit, and that was it. Now you can actually use these living benefits, and I'll show you exactly how that works. But first, let's take a look at that death benefit. I think it's very important to understand this, because this is unique to life insurance. Death benefits protect families in the event of the untimely death, and they generally are considered tax-free income. Now generally, because there are a couple of scenarios that it wouldn't be, but the vast majority of the life insurance benefit is tax-free. Now what does that mean? Well, let's say that you have a $250,000 amount on your life insurance. If you pass away, then whoever your beneficiary gets how much? $250,000, right? That face amount. Is there any tax on that? No. Now let's say that on the other hand, let's say that somebody had a 401k and they had some money in savings and that sort of thing, and they pass away. When the beneficiary cashes out that 401k, what happens? They have to pay tax on that. So that is reduced. So this is something that's important for everybody to understand, that death benefit is, in most cases, tax-free. And benefits can be used to pay anything from medical expenses to college tuitions or an outstanding mortgage. There are no restrictions on how that money is spent in the event of a death. Okay? So that gives that beneficiary a lot of flexibility. Now, let's talk about ABRs, or accelerated benefit riders. This is what happens, is that, hit the wrong button there, sorry, is that through this process you can actually accelerate the death benefit if you meet one of the criteria, okay? So if something happens, you have the critical illness or something like that, if it meets certain criteria, you can accelerate that death benefit and use it while you're still alive and not have to wait until your death, okay? So accessing the ABRs, there are 4 ways that you can do that. Number 1 is if you if you have a terminal illness and you're expected to die within 24 months. Okay? Chronic illness, unable to perform certain activities of daily living. Critical illness, which is, we all recognize this, cancer, heart attack, stroke. Most of us know people that have had one of those three, and some have had multiples of those, right? And then the last is a critical illness, paralysis, traumatic brain injury, or coma, something like that. So there are 4 different ways that you can access those ABRs, those accelerated benefit riders, and actually use the life insurance while you're still alive. I think that's outstanding. It's unbelievable, actually. All right, so let's also look at with the living benefits. There are policy loans and withdrawals, because you have cash value accumulation that can be used during your lifetime through policy loans and withdrawals. And there's no restriction on the use. You could use it for college tuition. You could use it for down payment on a home. You could use it for retirement savings, and to give you that stream of tax-free income. Now that's another thing. If you haven't used your death benefit, if you haven't accelerated it by the time, and of course if you haven't died by the time you get to retirement, then you can actually create a stream of tax-free income to supplement your retirement income. Remember that slide that we said there's a big gap between what the average person spends in retirement and what Social Security provides? Well, this product can be used as that retirement supplement as well. And the best part of it, since you're advancing the death benefit, which is tax-free, that money that you're pulling out is also tax-free. So it solves a lot of problems, doesn't it? Now, the power of indexing, we call it an indexed universal life. Okay, so what is indexing? Well, you never have to choose between safety and growth. Now let me back up here, I almost hit the wrong button there. It says you don't have to choose between safety and growth. Now what do we mean? Let's take it to the first example, safety. Let's say that I have some money and I want to make sure that that money is absolutely safe. I never have to worry about losing it, no matter what happens. If the whole economy crashes, my money is always going to be there. If that is my number one concern, where would be a good place to put my money? What do you think? Where is it absolutely safe? Not under the mattress. Your mattress could burn up and there goes your money, right? Okay. You don't want to dig a hole in the backyard. Maybe the bucket that you put it in will rust out and it'll, whatever. A bank. A bank is the best place to put your money if you're worried about safety, if you want to make sure it's always there. Why? Because the money that you have in the bank is insured, isn't it? Through the FDIC, Federal Deposit Insurance Corporation. So if anything happens, if the bank burns up, and theoretically your money is inside and burns up, which that's not really the way it works, but theoretically if that was the case, your money's going to be replaced. If the bank goes bankrupt and goes broke and they don't have your money anymore, they've lost it, doesn't matter. The FDIC will kick in and replace that, won't they? Now somebody once told me, well, Dave, there's always somebody that has to come up with a challenge on something. Somebody raised their hand and said, well, Dave, but the bank only insures it up to $250,000. What if I have $500,000? Well, put it in 2 different banks, right? Because each one is going to insure it for $250,000. So there you go. Okay, so that's the safety part of this equation. If that's what you want and you're only worried about the safety and knowing that your money is never going to go anywhere, you put it in the bank. What's the problem with putting your money in the bank, though, from a financial standpoint? What kind of interest does the bank pay you today? Yeah, maybe 1%, maybe you can find 1.25%, 1.5%, something like that, right? It doesn't pay you much of a return, does it? Okay, money's always going to be there, but the sacrifice is, in order to get that safety, you have to give up that return. You're not getting much in return. Okay, but think about this. So it's always safe. Our money's going to be there. We can't lose it. Well, is that right? Well, let's talk about a thing called inflation. You know what inflation is? We've all heard of it, right? I think the way to think of inflation is take everything that you buy today. And how much will it cost in a year from today? That increase is inflation. Right now, do you know what we're running? Our inflation rate is running about 2.5%, something like that. In other words, on average, everything, if you took all the products that you bought today and you marked them down what you paid for them and you did the same thing a year from today, you're probably going to pay 2.5% more. Okay? So, Think about this. What did we say the bank is going to pay you in interest on your money? Maybe 1.5. What is inflation going to cost? 2.5. So you're really losing money every year if you just put your money in the bank, aren't you? Because it's costing you more to buy everything a year from today than what the interest that you're going to make in that year. Okay, but it's always safe. Your money's always going to be there. It's going to be worth less every year, but it's always going to be there, right? Well, some people would say, you know what? I'd like to be a little more aggressive. I'd like to have a little bit better return than that. So if you're looking for a little bit better return and you're willing to risk a little bit, where might you put your money? You can say it, the stock market, right? That gives you upside potential, doesn't it? There are times when the stock market is just going up and up and up. Right now it's a little volatile. Up 500 points one day, down 600 points the next, up 300 the next, down, it's crazy. So that's the risk with the stock market, is you have that volatility and you never know for sure what it's going to do, and you can lose money, can't you? Well, let's take a look. This red line here, it's kind of looks like an orange line up here, but it's supposed to be a red line. Okay, this tracks the S&P, the Standard & Poor's, over the last 20 years, starting in 1998. So it says here, you can't see the numbers very well, so it says if you put $100,000 in the stock market, in the S&Ps, in 1998, this says that after 1 year, you would have had almost $120,000 worth of value. That's a darn nice return, isn't it? Almost 20% in 1 year. I mean, everybody that had money in the stock market back then, they couldn't get the smile off of their face. They were so happy, okay? Because they were just making money hand over fist. But then in 1999, going into the year 2000, what happened? No, it wasn't the new millennial. That happened, yeah. But what happened that caused this severe drop for 3 years in a row? Do you remember? Remember? No, not the mortgage. That was later. The tech bubble. Some of you are too young to remember, but I don't. I can remember. I'm not that young, okay? And what happened is that you had all these dot-com companies that came out, and investors were putting all kinds of money in them, basically gambling on that one of them was going to be the next Microsoft or Apple, okay? And the stock price went up and up and up, and that's partly why you had this 20% gain there. And then all of a sudden, reality set in. And everybody says, wait a minute, these companies are never going to make any money. I better get my money out, and all of a sudden, the market tumbled. For 3 straight years, the market went down, and your money, your $120,000 up here became worth a little over $70,000 after 3 years. So, that didn't sound very good. But it bottomed out. What goes up must come down, what goes down must go up, right? So, and then it started to go back up, and it had a nice little run here until about 2007. And what happened in 2007? The real estate bubble burst, mortgage and all of that, right? And boy, that was, here you can see, look at this drop. You had almost as big a drop here as you had over here, but this was all in 1 year. Boom. That market just dropped off the cliff, went back down to where your money would have been worth $73,000. And then you get some gain here, a little bit of a dip here, and we had a little dip last year, but overall, you're going to make some money. But there's a roller coaster effect there, isn't there? And you've got to have a pretty strong constitution to be able to look at your portfolio every month and see that money going down and say, I'm not going to worry because it'll go back up. All right? So that's the problem with the stock market. Well, guess what? Indexing combines the best of both strategies. So it gives you the security of being in a bank, and it gives you the growth potential of being in the stock market. As a matter of fact, this blue line says that if you had put your money into an IUL back in at the same time here in 1998, this is what would have happened to your money over the last 20 years. Now notice one thing about this blue line that is a lot different than the red line. There are no downturns, are there? That's the beautiful thing about an indexed product, is that when the market goes down, you just don't gain anything. So 0 is your hero, right? While everybody else is losing money here and losing money here, you're just staying flat. You're not losing anything. You're not gaining during those times, but you're not losing. But what does that mean? When the market starts back up, you're starting here instead of here. You're starting here instead of here. So that's the value of the indexing. It combines both safety and the growth opportunity. So, understanding a little bit about what we do, why we do it, and the products that will help us do it. Now let's talk about the opportunity with this vibrant industry. There's a tremendous need to